An insurance allows the insured, which is the person or business taking an insurance car, to gain financial compensation in the case of financial loss from the insurer, which is the business providing insurance covers. The insured will have to pay a monthly or annual payment of a premium to the insurer in exchange for the financial safety. Let's take a look at some of the key purposes of insurance. Risk reduction. Entrepreneurs take risks when starting a business. They do not know if they will make a loss or profit. By having an insurance cover, they can claim a financial compensation, reducing the effect of a loss. It's worth to note that as the risks increase, the premiums will also increase. Compensation. Businesses who have an insurance policy can take out a financial compensation in case of a loss. Compensation could also be paid to another party if the insured is responsible for the loss of that party. For example, if a brick falls on a visitor's head in a construction site, the insurer will likely cover the medical costs. Financial protection. Although an insurer cannot prevent a loss, it can reduce the impact of the loss by providing financial compensation. Without this, a loss would affect the business in a larger scale. For example, in the case of a natural disaster, the owner would have to cover the cost of reconstruction, which could possibly ruin the owner. Confidence. Taking out an insurance policy builds the confidence in a business because the entrepreneurs know that any loss will be made up for by the insurance. If entrepreneurs are confident about the business, they are likely to succeed. Investment. Insurance businesses can use the money they get from the premiums into investments. The insurance companies will then get financial returns, especially from investing in the shares of PLCs. Some of the money covers running costs and meet the cost of a claim by an insurer. Insurance principles. The insured can gain compensation only if the claim is fair and legal. So to make sure that the relationship between the business and the insured will work, both follow a bunch of principles, which we will take a look at now. Indemnity. The principle of indemnity states that the insured cannot profit from a claim. Once an insured has gotten a claim, they should not be any better or any worse than they were before. Contribution. The principle of contribution states that an insurer has the right to collect money from other insurers if the insurer has taken out more than one policy. For example, if a laptop is stolen from an office, it is covered by both contents and office insurance. So both the insurance companies would share the compensation to be paid. Subrogation. The principle of subrogation states that once compensation has been paid to the insured, any property recovered from a loss belongs to the insurer. This means if the laptop from the previous example was recovered, it belongs to the insurance company until the insured pays back the compensation in full to get the laptop back. Insurable interest. The principle of insurable interest states that these individuals cannot claim for losses made by other parties. Utmost good faith. The principle of utmost good faith states that both parties should be honest with each other. The insurer should clearly state the terms and conditions of the car. The insured should give accurate information with all details. Pooling of risks. Insurance companies want to make profits from the premiums. However, if an insured makes a claim, they have to compensate, and the value of the claim is usually higher than the value of premiums paid by the one customer. So the risks are pooled. Customers who do not suffer a loss help pay the claim for the customers who did due to the premiums that were paid. Forecasting losses. Insurance companies try to forecast the loss that might occur in case of an unexpected event. They calculate the probability through historical data. Fixing premiums. The price of the premium paid is decided based on the chances of a claim being made, amount of compensation that has to be made. If these two are higher, the premium is likely to be high as well. Actuaries. An actuary is employed by an insurance company to do some of the statistical work mentioned above. Actuaries are university educated and are very important for insurance companies. If they do not fix the right premium, it could result in a loss to the company. Assessors. An assessor is employed by the insurer to negotiate the claim with the insurer. They examine the insured situation and determine the real value of a loss. Assessors during a loss would organize support, discover hidden losses, get fair compensation, and help losses get restored quickly. Non-insurable risks. The insurer would not provide cover for certain risks. This could be because it is not possible to calculate the size of those losses. Some non-insurable risks include business losses, poor business management, fall in demand, changes in fashion, or war.